Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, October 5th, 2021, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Futures currently are showing a rebound. Dow futures up about 176 points, S&P 500 futures up about 20, and the NASDAQ futures up 61. NASDAQ's been hit harder of late, no doubt, but all of our major indices really coming under a lot of pressure. We'll see whether or not today we can kind of kickstart something back to the upside, or whether this is just a brief little rally before we set some new recent lows. Let's take a look ahead at what we're going to talk about today. So we'll get into the daily market recap, then talking technically. I'll show you what I'm looking at in terms of a possible ABC correction. Then we'll get into break it down. Going to use show you how to use rate of change, look at some technology stocks. Industry analysis. I've got a number of various industry groups I want to pull up and just show you some key levels, whether they be to the upside or the downside. Then we'll get into earnings spotlight. Not a whole lot going on there, and then we'll wrap it up with three you must see. Three NASDAQ stocks that I think you're all going to be pretty aware of. Take a look and see what's going on there. But before we get into any of that, let me take you over to earningsbeats.com for those of you who are new to Earnings Beats. Again, if you go to earningsbeats.com, then just simply scroll down. You'll see we have a free newsletter. You can subscribe here. Simply type in your name, email address, hit that subscribe button. This is a newsletter that's published 3 times a week, Mondays, Wednesdays, and Fridays. Normally out by about 8:30 in the morning. It's a very brief read, normally just one stock talking about, maybe relative strength, maybe it's coming up for earnings, maybe it reported earnings and looking at the gap. But there's something technically that looks interesting to me, and maybe it's just part of a group that's doing well and on the verge of a breakout. Could be any number of things. But I'd love to have you join our community. Again, just your name, email address, hit that subscribe button. There's no credit card required. You can unsubscribe at any time. Love to have you. All right, let's take a look first at the daily market recap, see what happened on Monday. It was not pretty. Dow Jones Industrial Average down 323 points, continuing the slide that we've seen now for better part of about 6 or 7 weeks on the Dow. S&P 500, which topped in early September, fell 57 points to close right on that 4,300 level. Still looks like it has downside to me, but we can have a bounce up to the 20-day at any time. Getting back through the 20-day would be bullish. Until we do, I think you've got to respect this downtrend. NASDAQ down 311 points. So on a relative basis, here was your loser for sure on Monday. Not a very good day. Finished down at 14,255. Getting pretty close to the breakout level, which was right around that 14,200 area, also where we tested. We went back down in July. So this would be an interesting area to start seeing some buying coming into the NASDAQ. Mid caps down about 0.6%, down 16 points. Then small caps down about 5 2/3 points, or roughly 0.4%. So these two, mid caps and small caps, actually were your relative winners among the major indices. Looking at the sectors, energy, again, strong. We talked about that 55, 56 area. Well, we got there. Went up into the 55s. Yesterday closed at 54.72. The XLE up 1.6%. Utilities also strong, up 1.4%. Utilities typically do very well in September and October, and you can see September was a horrible month this year for utilities. So maybe we're going to get a little catch up here in October. Technology, the worst performer, down 2.3%. Under pressure, you can see we've gotten that death cross now where the 20 drops below the 50. I'm talking about moving averages, 20-day versus the 50-day. Communication services got that same configuration of death cross. This was down 2.16%. And then healthcare, which has really been struggling here over the past 7-8 trading days, down another 1.5%. So all three of these groups you can see under a lot of pressure. When I look at the AD lines, it looks like communication services may be the weakest just because we're dropping so rapidly right here. And we're doing so on some very heavy volume over the past few weeks. Moving on to the 10-year Treasury yield. Currently, well, it's still a little early here. I can probably get you. Let me see what we've got. Looks like we're up about 1.5 basis points, just under 1.50%. It's not showing up on your StockCharts chart, but it will shortly. With the yield continuing to rise, that certainly is putting some pressure on growth stocks, which is why the NASDAQ's being hit a little bit harder. But it also helps areas like financials. And you can see that on this chart right here. As we've had this move to the upside in the yield, you can see financials. This is a relative chart. This isn't just financials going up. This is financials going up relative to the S&P 500. And we're now up to about a 3.5 month, almost 4 month relative high on financials. So financials, like the rising yields, if it continues, you should see financials making a run for that June relative high that we saw. Industrials typically do well with rising yields as well. Now, it's been struggling a little bit, the group as a whole, relative to the S&P, but it does look like we're starting to turn back to the upside. This is a group definitely worth watching. Airlines are beginning to move. We'll talk about them if I have some time just a little bit later in the show. All right, let's move on to, well, actually, before we do move on, let me just tell you there is one economic report, actually 2 economic reports out this morning. September PMI composite will be out later this morning. 54.5 is the estimate there. And then September ISM services, the estimate there is 60. So keep an eye out for that. That could have a slight impact on what we see going on in the 10-year Treasury yield. All right, now let's move on to talking technically. And the S&P 500 is a chart that I showed members yesterday in our daily market report. But essentially, what I'm looking at in terms of a pattern here is the first drop going down below the 20 and also below the 50. And that's not unusual, by the way. We've seen moves below the 50 on multiple occasions throughout this move. So I wouldn't read too much into that, especially being in the fourth quarter, which typically we see the market go higher. Not always. Think back 2018, the trade war. Wasn't that long ago. We actually had a cyclical bear market right in the middle of the fourth quarter. So anything goes. But historically, the odds favor prices moving higher in the fourth quarter. But as you look at the S&P, I see an A drop, a B rally, and then a C drop is what I'm looking at. So we did move and put in a lower low. So now it does qualify as that ABC pattern. To negate it, we're going to have to get back up through our moving averages and get through that top of that B. So that B rally up there. So we're looking at about 44.70. So it's going to take a good 4% or so on the S&P 500 in order to get back up and negotiate that recent high, that reaction high. But I wanted to spend just another couple minutes looking at the NASDAQ, because the NASDAQ's been hit harder. And it, too, to me, is in this ABC correction. Now, this is the NASDAQ 100. I'm going to pull up the NASDAQ itself, because I think that there's a pretty big support area that we need to be thinking about here as well. I mean, we had a double top at about 14.2 right here. There's your double top. This is also an ascending triangle. So you've got high or equal highs, and you've got rising lows. So I can pull that up. So anytime you've got equal highs, rising lows off of an uptrend, which is what we have here, uptrend, then we establish this as point A, B, C, D, E with the breakout. Now the measurement there at the time I wrote, this should take us up to about 16,000. We didn't get there. So I'm not sure that this pattern is quite complete yet. But if you notice, we pulled back and look right where we are here at this 14.2 area. So we've got some support here. Your ABC is essentially A. Let's see. Just drag that over there. That's basically B. And what we're in right now is C. And this has come all the way back down to this support area. So A, B, C is the pattern. Now, could we break 14.2? Of course, we can do anything. If we do, then to me, it sets up much more bearishly. So I think we have to recognize that the breakdown at 14,200 would be much more bearish, and I think would take us from a short-term ABC decline to something we need to evaluate more from an intermediate perspective. So as far as I'm concerned, this is just something, we're going through September, or we went through September. It's not unusual to lose ground in September. We did that. We've got an ABC correction, which is not unusual at all in an uptrend. But if we break that 14.2 area, and we were down to 14,181 yesterday before we started to rally, then we've got to look, I would say, out more at a weekly chart and begin to look, okay, what's going on here? At this point, I would say your 50-week moving average, which is 13,693, that would be the next stop for me if we can't hold 14.2. That's what I would be looking at from an intermediate term perspective. Now, I'm not going to write about some kind of a bear market coming, talk about a bear market, when we've been in a uptrend now really since 2013. I mean, we had the trade war right here, and there was your fourth quarter weakness. We also had the pandemic, obviously, for a month or so that was devastating financially. But outside of that, we've been in an uptrend for quite a while. So I don't look at this as though the rally is over. Instead, I look at this as an opportunity. We'll see what happens. All right, moving on to break it down. So I wanted to talk a little bit on, pulled up the S&P here, but this time at the bottom, you'll notice there's a rate of change, 21 days. You might think, okay, why 21 days? Well, since we topped here on the second trading day of September, and I believe that was on the second, I think the first was the first trading day. From September 2nd to now, there have been 21 trading days. So what I was looking at is how much has the S&P 500 dropped over the last 21 days? And here is how you can do it. You put that rate of change on there and you can see minus 5.21%. If you look back over the last year, this is the biggest drop that we've seen over any 21-day period. So definitely something to think about and consider. Now, I'm also going to show you, I'll do the NASDAQ 100, the NDX, using the same rate of change. You can see that's down 7.26%, which is more than the S&P 500. However, it's not more than what we were down back in March. I mean, it's been bad, but here was March, A, B, C. It looked like we were done, right? And then we ended up coming right back, going back up and setting new highs in April. Pulling back one more time, we were down to about minus 7% here over a 21-day period, and then took off again. So I wouldn't write the market off just because we're having a rough patch. Rough patches happen. You can't go up every day, every week. So I'd be looking for some strength sooner rather than later, especially now that we are in the fourth quarter and we're starting to move toward earnings. Like I said, if we can't move now and we do start to break back down again to new lows, then I think we have to start looking at it more on a weekly chart. Now, I thought this was interesting, so I wanted to also take a look at a couple of the big names like Apple and Microsoft, and look at them on the same chart and see how they stand on this 21-day test. And Apple right now is down 9.44. So Apple's going down faster than both the NASDAQ and the S&P 500. And when you've got the largest component of those two indexes getting hit like this, it's going to be difficult for those two indexes to do very well. Just like when Apple's doing well, sometimes that masks what's going on in other areas of the market. We have to also be conscious of that effect when Apple is declining. Back in February, we actually got to about a minus 15. So if you're looking at how this compares historically, and we could stretch this out to go back 3 years and see, what's the biggest? Well, obviously the pandemic, we were down almost 30% in 21 days. 21 days is just over 4 weeks, by the way, 5 trading days per week. So 21 is roughly 4 weeks. But you can see multiple times where we've gone down 15 or 20%. There's 20. Here's 15. Of course, the pandemic was almost 30. 15 in September, October last year. 15 earlier this year when growth stocks were hit. And now here we are down, 9%. So from a historical perspective, this drop in Apple is not really as bad as you might think. Microsoft, try to go through here and see where we are. Microsoft right now is down 5.99%. That's not bad considering what the market's doing. It's just kind of going down with the market. And if you look back, 10% has kind of been the norm for significant sell-offs. 5% has been hit multiple times. We bounce off of that area. So this is an area historically where maybe we do see Microsoft bounce back a little bit. How about Google? So Google, which hasn't fallen more than 5% in quite a while, October of last year, so it's been about a year, is currently down 6.72% since that S&P 500 high on September 2nd. But historically, throw out the pandemic, I think that's a one-off. But you can see other periods where we get down to about 15%. So it's not out of the realm of possibilities that we do see a little bit more selling here. Facebook's been getting hit pretty hard. You can see down now 13% over its last 4 weeks. And that is getting pretty close to this 15% threshold where we generally turn on Facebook and begin to turn back to the upside. How about Tesla? Look at Tesla, actually up 6.71% over the last 4 weeks. So it's going the other way. It's actually one of the stocks helping to keep the market afloat. Amazon's been getting hit of late. Amazon down 7.89%. Netflix has been a strong stock. And you can see over the last 4 weeks, it's up 2.5% and breaking out above these prior tops. Netflix definitely, I would say, is the best looking FANG stock at this point. That's pretty much what I wanted to go through. But, this is a cool tool, the rate of change, and being able to change the periods like I did. I think the default's 12 periods, but I just changed it to 21 because I wanted to see how each of these stocks had performed since the S&P 500 topped. So you can get it's a different way of you maybe looking at relative strength. You can look at the rate of change to see how it compares. All right, moving on. I wanted to take a look at the industry groups. I wanted to go through a number of industry groups and just highlight some that I think look interesting at this point. Mobile telecom. I think it's pretty clear that we've got support down just below 390, and we just hit that, trying to hold on at this level. If we do go a little bit lower, I think it's going to come with positive divergence. So mobile telecom is an area I would expect to bounce sooner rather than later. Broadcasting and entertainment. The low back in May, 1900, got down to about 1940 and change. So in a downtrend, but getting closer to that level. I'd watch that. How about internet? Just talked about Facebook, Netflix. Well, internet's been under some pressure here. I would like to see this 3,500 level right here hold. We went down, went just below 3,500, bounced. We'll see whether or not that is ultimately the low or not. But we still got a lot of work to do. PPO's weak, got to get back through the 20-day. So it's gonna be a little difficult here, I think, for internet. Automobiles look pretty strong. So here the autos got that double bottom back in March and May. And now as we move up, we've taken out the April reaction high. That's pretty bullish when you have a double bottom and a high in between, and you go back up and take out that high. I think this bodes well. I would expect autos at some point to make a run for that 1100 area. All right, how about recreational products? Double bottom right here at 620, triple bottom because just about 2 weeks ago, 2.5 weeks ago, we went down, tested that 620 level. And then on Friday, we're down pretty close to it as well. So no doubt 620 is a big level on recreational products. The more groups that we see start to lose key support, the more difficult it's going to be for the major indices to hold their support. Footwear also coming down to a key area of support. We had the triple top right here coming across. That was at 2650. The recent slide has taken us right down to that 2650 area. How about hotels? One of the best areas. This breakout above 2,600, very strong. I would say as long as that rising 20-day moving average holds, this is a group that's become much safer to trade in. I like a lot of the hotel stocks right now. All right. Restaurants. So restaurants, I mean, I don't know if it looks to me like we've got a trend line maybe. Well, if we connect like that, it looks like we're breaking down. But we also could connect where we just finished at low, which would still intersect these 2 points right here. So it's kind of hard to say exactly. Trend lines are so subjective. You can make it look worse than it is and simply, do that and say we've broken down, or I can do that and say we've held. It really depends. It's the, depends on the eye of the beholder, whoever's, got the annotations, however you want to set it up. So you can make the bearish argument that the trend line's broken, or you could say we're testing the trend line. There's a couple things that I would be looking for in addition to trend lines, and that's price support. I mean, right there was a breakout. We've come down. We went a little bit below it. We're trying to hold on. There's another support area right here where we broke out, and then finally that low right here. So, I mean, again, it's kind of like the trend lines. There's multiple support levels. Which one's most important to you? I think using a combination of both trend line and support lines, once you see they've all been exhausted, then you've got problems. At this point, I'd say there's still an argument that the restaurants are still okay. Apparel retailers going down, hitting a key support level right here. June went down just below 1150, almost to 1150 in July, and just below 1150 again now. Do we hold this support level? Banks. Well, banks trying to break out. Got up to 600. Yesterday went up just above 600 and then pulled back. But we are trending higher. Watch that 20-day EMA. That PPO looks strong. So even though we failed on the breakout, if we come back down, test the 20, and we hold and then break out, very bullish. If we go through the 20-day, then I think what we've got is more sideways consolidation. Maybe point A, point B, point C. Maybe the next pullback will be point D in an ascending triangle, or maybe we go all the way back to 520, and have sideways consolidation. But we have an uptrend. I look for a period of consolidation and then a breakout, especially being in a secular bull market. How about life insurance? Life insurance, I was looking at, it looks almost if you connected the highs, they're downtrending. You connect the lows, they're slightly uptrending. This could be a symmetrical triangle that's beginning to squeeze after an uptrend, which also would be a continuation pattern. If there's one negative here on this chart, it's that AD line, which has really taken a hit, even though the price action hasn't been bad. So that would be a confirming indicator if we were to break down. I wouldn't use this as my primary indicator. All right, just a couple more here. Medical supplies breaking out here above roughly 1,400, maybe 1,450 or 1,425. And we've gone back down now below 1,450. So we're getting closer and closer to an area where I would expect some price support to kick in. And we got heavy construction. I see a cup. So you got a big move up, nice rounded cup. I think we're in this little handle right here. Watch for a breakout above 775. We talked about industrials and how they were starting to make a move to the upside. They love the month of November. So as we get closer and closer to November, if we get this breakout, I think we could be in for a strong run. So watch heavy construction. Industrial suppliers back down at support, this key support area 470. This was also a breakout area. So this is a group that I think we need to keep a close eye on. And then the last one I have for you is the airlines. The airlines, which had been under pressure. Airlines love the fourth quarter, by the way. September, October, November. And you can see technically here was that breakout, and look at the pullback and holding the 20-day and then moving back up and breaking out again. That's what you want to look for in an uptrending stock or an uptrending index. PPO looks good. I think airlines look like they've got more room to run to the upside. So those are some of the key industry groups maybe to keep an eye on. Let's move on to earnings spotlight. Not a whole lot going on here. Pepsi, I did not see the report, but I know that last time I looked, they were up a little bit in pre-market. And this would be an area I would expect to see a little bit of a rally. When they reported back in July, you can see the gap up. So you got this support area around about 148.50 to up to 150. And we went right down into that zone the last couple of days. And then today, and we can get a quick update, see where it's trading pre-market. Right now it's up 1.19%. So 1.19%, 151-ish, 151 and change. So here you've got probably that overhead 20-day EMA to look at. AD line has not been great. So after a gap up, we may see some selling. I'm not really a huge fan of Pepsi, but I would watch that support area, 148.50 up to 150. All right, let's move on. Like I said, there wasn't a whole lot going on with earnings, but let's move on to the 3 you must see, and we'll wrap up the show. Going to start with Twitter. So Twitter was one of the biggest losers yesterday on the S&P 500. In fact, I've got 3 of them that were on that list I'm going to go over. But Twitter, I think, is just really going sideways. It's been doing that for the last year. I mean, we're not much higher than we were a year ago. And when you think how much higher the internet group has gone, that's why Twitter, which had a huge move here back in February on both an absolute and relative basis, it's back down near a 52-week low relative to the internet group. So it's just not a great area, a great stock. And it broke down yesterday. So if I'm looking for an internet stock, it's not going to be Twitter. And I don't know which way Twitter goes from here, but I'm just not going into a stock that's broken. Facebook. Facebook was looking pretty good, but it is rapidly deteriorating on its AD line. Huge volume the last 2 or 3 weeks, accompanying a big move to the downside. And yes, internet's been going down, but Facebook is down right now near a 6-7 month low and not too far from its 52-week relative low versus the internet stocks. So you've got a strong group, but like Twitter, I would say Facebook is not really going to be the stock that I would be looking at in this space. Now we're going to move on to the semiconductor area where we take a look at NVIDIA. So semis, now the AD line here has been still remained very strong. And even the selling that we've seen, yes, the volume's picked up, but it's nowhere near the volume that we saw on the upside. So we failed to hold the breakout level, which was up closer to 210. We're now below the moving averages. But I believe I'd be looking at these support areas if NVIDIA continues to sell. I think 190 and 180 would be great entry points on a further pullback. All right, that's it for me. I want to thank everybody for tuning in. Make sure you join me on Wednesday morning over at Earnings Beats. You can go in, click on this Trading Places Live. Earnings Beats, I do shows Mondays and Wednesdays at 9 a.m. Eastern. So come on over tomorrow, hit Trading Places Live link, join me at 9 a.m. for your next episode of Trading Places Live. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.